If you're over 50, the 60-40 rule isn't a safety net. It's a mathematical trap tightening ahead of the Fed's decision this September, while Wall Street advisors, the ones collecting commissions regardless of your performance, still call this strategy safe. The math says otherwise. In this economy, that 40% in bonds isn't a parachute. It's an anchor dragging your nest egg to the bottom. The brutal truth. The standard advice you're paying for was built for the 1990s, not for the world you're retiring into in 2026. If your advisor hasn't warned you about what's coming this September, that's your first sign to keep watching. I'm not speculating, and I'm not guessing. Berkshire Hathaway just closed a quarter holding $397 billion in cash and short-term treasuries. That's the largest cash position in that company's history. Berkshire isn't sitting out, it's positioning. It has moved 59% of its entire investable portfolio into cash while the experts tell you to keep buying at all-time highs. Today, I'm giving you the 3 moves built on that exact playbook. Move 1 fixes your immediate risk. Move 2 protects your buying power. But move 3 is the secret shield that makes the first 2 actually work. And if you skip it, you are effectively volunteering to pay the IRS more than your own family. Let's start with the bond problem. For 30 years, bonds were your ballast. But with inflation remaining sticky as we head through 2026, a long-term bond doesn't protect you. It bleeds you dry. Think of it like climbing a staircase where every step you take, the floor beneath you vanishes. You're safe on paper, but your purchasing power is leaking out the bottom. The fix is this: we're abandoning long-duration bonds for a short-term treasury ladder. We stagger the money so it's expiring at different times, some in 3 months, some in 6, some in 12. The goal isn't growth, it's control. We're building a cycle of liquidity so that when the market finally corrects, you aren't forced to sell your stocks at a 30% discount just to pay for groceries. Now your suit and tie advisor might tell you bonds are mandatory for your age. And they were, back in 1995. But applying a 1995 playbook to a 2026 reality is how people lose 10 years of retirement progress in 10 months. Your advisor isn't telling you about this because it doesn't show up in a standard brochure, but pricing power is the only thing that beats inflation when your bonds are failing. And that brings us to the most important move for your survival. Move number 2, the moat pivot. Now I know gross margin trend sounds like a cure for insomnia, but this one number is the difference between a portfolio that grows and one that just survives. The smartest money in the room isn't chasing speculative AI startups. It's buying companies with a competitive moat. Businesses that can raise their prices faster than inflation can eat your savings. Don't swing for a jackpot. Look for protected growth. Check that one number, the gross margin trend. If a company's margins are holding steady even as its costs rise, that's a sign of real pricing power. Let's make this concrete. Picture 2 companies. Company A sells a product everyone needs, but the second a competitor undercuts the price by even a few cents, customers leave instantly. That company has no moat. It's stuck competing on price alone, which means rising costs eat directly into its profit. Company B sells something people trust enough to keep buying even when the price quietly creeps up year after year. That's the moat. That's pricing power in action. You don't need a finance degree to spot the difference. You just need to look at whether a company's margins are shrinking under pressure or holding firm. That single comparison repeated across a handful of companies is how you start building a protected growth sleeve in your own portfolio. One that's designed to outpace inflation instead of just hopping to survive it. That one number on a balance sheet is more valuable than any stock tip you'll hear on the news this year. We've fixed your risk and your growth, but if you don't secure the secret shield in this final move, the IRS will still take their cut of everything we just built. Finally, move 3, strategic cash. Most people think cash is trash. They're wrong. To a disciplined investor, cash is optionality. It's the tool you use to buy the next crash at a steep discount. But here's the catch the government hopes you miss. Location is everything. If you hold this cash in a regular brokerage account, the IRS takes a real cut of your interest every single year. You'd be quietly funding the government's budget with your own retirement safety net. Here's how this actually plays out for 2 different retirees holding the exact same amount of cash. Retiree 1 keeps their treasury ladder sitting in a standard taxable brokerage account. Every bit of interest that account earns gets taxed as ordinary income every single year, whether they touch the money or not. Retiree 2 holds that same ladder inside a tax-free or tax-deferred bucket. Same investment, same interest rate, same starting amount. But very different outcomes over time, because one retiree is quietly losing a slice of their safety net to taxes every year, and the other isn't. This is the part most portfolio reviews skip entirely because it's not about what you own. It's about where you hold it. You need to place this cash in a tax-free or tax-deferred bucket to keep the shield active. Shifting to a treasury ladder fixes your liquidity. Rotating to moat companies protects your buying power, and strategic placement protects your gains. But even this playbook can be undone by one single oversight. If you fix your portfolio but ignore your tax exposure, you've left the back door wide open. That's exactly why you need to watch the breakdown of the $45,000 tax mistake right now. That video finishes the protection plan we started today.